Okay, so I'm on page 105 of the textbook. Liquidations of controlled subsidiaries. So this is a different situation than we talked about before. So complete liquidation of a sub, and if you look at the general rule there, A, no gain or loss shall be recognized on the receipt by a corporation of property distributed in complete liquidation of another corporation. And the issue about control is in 332 little b, liquidations to which this section applies. You know, it's only in complete liquidation only if the following things apply. You've got the control requirement of 150482, which is basically 80%. And it's supposed to occur, number 2, within the taxable year, or it could be a series, number 3, following a plan. And if it doesn't occur within the year, then the IRS can step in and make you give a bond or waive the statute so that they can check on it. So that's 332. So that's the basic start. 334. The basis of property received in liquidations. The general rule is, you know, if gain or loss is recognized when the basis in the hands of the distributee is fair market value. But we're interested in 334 little b because we're talking about liquidating a subsidiary. So the general rule is if you have a distribution in complete liquidation where 332 applies, the basis of the property in the hands of the distributee shall be the same as in the transfer, or unless big A, you have a gain or loss recognized. So basically what they're doing is you're basically going to end up with a carryover basis if you're the parent, and the assets are distributed to you in liquidation of the subsidiary. You get a carryover basis. So it's a, quote, tax-free, but it isn't really tax-free, but it's tax deferred. It's not a taxable transaction. 337. Non-recognition for property distributed to parent. This is looking at the subsidiary. No gain or loss shall be recognized to the liquidating corporation if it's to the 80% distributee. And 337B1, debt could be a problem, but and the textbook talks a little bit about it. Basically, you're looking at the 80% rule. If that happens, there's not going to be a gain or loss to the subsidiary. Now, if the property is not distributed to the parent, you have minority stockholders, then there will be gain recognition, but not loss. By the way, you might think having the solutions manual is really helpful to me. No, I'm telling you, it's these people, I guess they do this for a living, and it's 24/7. You know, sort of like, you know, kind of like I am with estate planning. I kind of know what to do, or at least know what to look at, and can talk about different ways to solve something. You're probably like me, you're just struggling to see if you can get the basics. And, you know, when I test this, I'm more looking for issue perception, not necessarily the actual solution sometimes. You know, just what's the potential problem here. I think this book is great at telling us that. They don't always tell us the solutions. The other thing is we're going to move into chapter 15, which is basically tax-free rewards. And the only reason I'm doing that is I don't pretend to be a specialist in that at all, okay? But I want you to have struggled with the material so that when our guest speaker comes in, you actually will have some idea what he's talking about, and he teaches you this is what tool you use. And so basically, in the real world, what happens is, you have all these tools, and you have a client that wants to accomplish something, and you have other issues they're trying to accomplish, and you have to make sure you can, structure it so that it works for them. And the other thing is, and I couldn't get a clear answer on this, but my recollection is, under 368, if you're doing a quote tax-free reorg under 368, you're going to get a private letter ruling at a minimum. There's just usually millions and millions of dollars writing on this thing. I can't conceive of you just giving an opinion, because I don't think you have enough malpractice insurance if it turns out you're wrong. So I think that's an area of ruling, but I couldn't get an answer to that. Maybe we'll ask Paul when he's here about that. A ruling's expensive, but it's not as expensive as a reorg that doesn't work and becomes taxable. That's horrible. So anyway.
Are you always guaranteed a response?
Say again?
Are you always guaranteed a response for those rulings?
Well, the thing is, what I was trying to find out is if they'll rule in that area. I think they still will rule in that area. Yeah, they're going to give you a response. You tell them what you want to do and how you're going to structure it, and they'll look at it and say, well, this isn't going to work because we're not going to allow this. And then you adjust your ruling and what you're actually doing to make it fit what they want, and then finally say, okay, if you do it this way, and these facts you gave us are correct now, then it will be a tax-free reorg. So some areas they won't rule, but I think that's an area where they really will. But it's expensive. But again, not as expensive as a reorg that doesn't work. The 381 is probably a little too deep for us right now. 381, section 381, carryovers and certain corporate acquisitions. If you have an acquisition of assets of a corporation by another corporation, and you have a distribution from that other corporation with 332, liquidation of subsidiaries apply, or some other stuff. Below that, the acquiring corporation will succeed to and take into account at the time of the distribution the items in subchapter C. In other words, basically you're going to take over a lot of the net operating losses and things like that. There's all sorts of restrictions about where you can use those. You may be able to only use those going forward. Now, you may not be able to go back and generate a refund, but you may be able to use them going forward. 381 is pretty long. And then the regulations under 332, the sub-liquidation. In our code, we don't have too much. I think they left out some. Some on page 1312 if you have the new code. Looking at the regs, 1.332-1. Distribution and liquidation of a subsidiary corporation generally. Normally you have a gain or loss under 331, but middle of that paragraph, section 332, excepts from the general rule of property received under certain specifically described circumstances by one corporation in complete liquidation of stock of another, and provides for the non-recognition of gain or loss in those cases that meet the requirements. It does warn you, which we didn't normally talk about in touch with. If you're dealing with foreign corporations, the rules are usually different. You need to, foreign corporation, that would raise an issue, okay? You're not going to know the answer, but you would raise an issue because the rules are probably going to be different here. They're saying that they are. And 332-2, 1.332-2, requirements for non-recognition of gain or loss. The non-recognition of gain or loss is limited, and you need to have 80% combined voting power of all classes and 80% the total number of shares. And again, these 80% things, to me, that's just an issue. You gotta know the 80% rule, but 80% of what? They're all a little different in our textbook. Our authors tell you, watch out for this because, you know, they use a different 80% rule. Well, those are really super sophisticated things. You know, if I happened to get that client walking the door and I happen to be dumb enough to want to handle it myself, that's one of the first things I'm going to look at is what's all the stock ownership and, you know, what 80% rule do we have to meet? You know, so it's an issue. I don't expect you to walk around memorizing, you know, how to apply it so much, but the fact that it's an issue. Okay, so that's that 80% rule is discussed there. And let's see, -1, -2. If you look at 332-2, little c, to constitute a distribution complete liquidation under 332, the distribution must be made by the liquidating corporation in complete cancellation or redemption of all the stock in accordance with a plan of liquidation or a series of distributions in complete cancellation of all the stock. And where there's more than one distribution, it's essential the status of the liquidation exists at the time of the first distribution. So, you know, probably that plan, whatever constitutes a plan, you want to make sure you meet that minimum requirement. And let's see what else. The proposed reg 1.332-2 requirements for non-recognition. Again, I don't know the difference of it. You know, if I studied it for 20 hours, maybe I'd get it. 332-3, again, these are proposed regs, but apparently they may be decent guidance. Liquidation completed within a taxable year, and then on the next page, 332-4, 1.332-4, when it covers more than a year, the issues that you're dealing with there. Now, bottom of page 1314 in the regs, 1.332-5, again, proposed regs, deals with distributions and liquidation as affecting a minority interest, which is one of our, the questions at the back of the chapter really weren't too hard compared to the body of the material, in my opinion. But anyway, it says, again, upon the liquidation of the corporation, we're pursuing a plan of complete the gain or loss of minority shareholders shall be determined without regard to section 332, since it doesn't apply. So we're going to find out there that you're going to recognize gain. You will recognize gain, but you won't be allowed to recognize a loss because you minority stockholder. So the questions at the end of the chapter kind of give us a little help with that. And I think that's all I want to do with the actual code itself, trying to look at it a little bit. Okay, so I'm in the textbook. We'll kind of go through it a little bit, highlight some of the things. Again, to remind you, the general rule is that when you have any sort of distribution, it's a sale of assets, and you're going to have a gain or loss. But when you have a controlling shareholder, 332 and 337 apply a non-recognition rule. For complete liquidations where you control, the definition of control is under 150282. To the extent assets are received by the controlling parent, neither the parent nor the subsidiary recognize gain or loss on the distribution. And then it warns you under 336 D3 that the subsidiary can't recognize any loss.
Excuse me. My textbook's got a typo, I think on line 8 it says 1502, but it should say 1504, shouldn't it?
That's possible. I'm not. I didn't look at 1502.
Because the ones in the box below it will say 1504.
Oh yeah, that confused
And
me
then
too.
1504's not really on there, it's what's at the
So
very
you-
top here.
Okay, is it 1502, the code section, or 1504?
I believe it's 1504A2, because that's what's above it in the top,
Okay.
and that's what's in the box as well. And there is
Oh, I see.
there is no
I-
A2
yeah.
on that.
Yeah, I see it, yeah. Yeah, because it's listed there, okay. Yeah, it's 1504, okay. Okay, they have a box talking about control, definition of control. Most of the time it's 368C, which is the reorg section. The condition on control, again, there's 1504, so you're right. The test of 368 requires 80% of the vote, 80% of the total number of shares. And it's pretty easy to apply. 368, but in 1504A2 requires 80% of the vote and 80% of the value. And value is an issue. Yes?
Just putting this out there, in the little box at the very bottom, they also mentioned section 1502, so maybe 1502 is something else.
Yeah.
Yeah, they do that on the very bottom.
Okay, so let me just take a look and see what 1502 says versus 1504.
Look all over town.
1502 is a 50 short.
Do we even have it? Okay, 04 is definitions. So 1504, A2, 80% control. Okay, so that's correct.
Just recognize.
So we don't have regulations. So 1502 apparently is the source for the regulations. This is the statute that gives them specific authority to do them. So that's why I think that at the very end of that box there, that is correct. Promulgated regulations probably going to be 1502. Dealing with who can file a consolidated return, those sorts of things. But 1504, while we're here, you see little a2, 80% voting and value test. And what the textbook is pointing out to you is value is another issue that you have to worry about. So that's some more appraisals. So again, 368A versus 1504 may be a little different. I'm pointing that out to you. And also on 106 in my teacher's manual, they point out that the caption might be confusing there because the caption to that setup is 332 liquidation to minority shareholders when 332 applies. And they're saying that the sales to shareholders are under 331 where you do recognize gain. It's not, so that may be a little confusing. All they're referring to is 336D. So they don't talk about 331. Below that, they do talk about that. Minority shareholders under 331 and 336. And 336D3 says no loss will be recognized even through distributions to minority shareholders. So later on, from a planning point of view, if you have assets with a built-in loss and you're going to liquidate the sub, what do you think you might do to take away the problem? I mean, you could transfer the loss assets to the parent, couldn't you? And they would get the larger basis, the built-in loss, they get the larger basis. And sometime in the future, they can either, maybe it's depreciable, or sell it and reduce reduce the gain. But if you distribute loss assets to minority shareholders to buy them out, that doesn't work. You can't recognize the loss. So what do you think you should do? What if you don't want to give the lost asset to the parent? You can't see any use for it. Sell it. If you sell it, you can report your loss on your tax return before you, go ahead and let the parent give this up, liquidate this up. So that's a planning issue there, and
What do they mean when they say like some of the sections don't apply, don't depend on whether or not you file a consolidated return? Is that
yeah, this is 1504, 1502. They're dealing with the consolidated return requirements,
right?
and there's different rules. So you may, again, I don't know because I don't even teach consolidated.
But I think it said the consolidated return like rules trump these rules. I think that's what it said. Like if you file a consolidated return, pay attention to those rules first. I think I read that, but I thought that
Yeah,
was,
I think you could be right.
I thought that was kind of,
There's a difference. You have to be sure you qualify under 1504, the 8%. And the regulations on who can file a consolidated return are different from 368A1 tax-free reorder stuff as far as the control. So, I mean, the issue there is control rules are different, and the consolidated 8% control rules are even more complicated. So, yeah, you're right. Again, the only thing I get out of that is I'm going to be worried about 80% in this particular area, and I'm going to want to be sure that you meet the definition. That's all. I don't have in my head where the consolidated stuff is different, but it is. The value thing is definitely in the statute. It's different. Okay, so then they have this box here. The operation of Section 381 and Section 332 liquidations with minority shareholders. And it says 381, 337 strongly indicate that the controlling parent succeeds to all the tax attributes of the 100% controlled sub when you liquidate the 100% controlled sub. So that's not a problem, right? Because you don't have any minority shareholder. Thus, all the subsidiaries' earnings and profits and all the carryover items are inherited by the parent. But next paragraph, what if there's a distribution to minority shareholders? It says there's nothing in the language of 381C where you normally look for special rules that suggest the parent should inherit less than 100% of the carryover, etc. Next paragraph, at 312, they step in because you're dealing with earnings and profits and dividends and those sorts of things. So if you remember the effect on earnings and profits of a recognized gain on a tax return, right? It's additional earnings and profits, the gain. And technically, you're supposed to calculate the related tax on that and reduce the amount available for dividend treatment by the related tax first. So you report, let's say $100,000 realized and recognized gain, and that would add $100,000 to earnings and profits, because you may recall earnings and profits starts with taxable income, but now they're asking what is the effect of an addition, and it would increase your taxable income by $100,000. But you also, for your earnings and profits calculations, you get credit for taxes paid on that $100,000. So say the rate was 25%. Earnings and profits would be reduced by that $25,000. So your net effect on earnings and profits would be 100 minus 25 or 70. So that's what you're dealing with there. Bottom of page 107, you know, what about section 332? Is it an elected provision? No, it's mandatory. If you meet it, you're stuck with it. Can you work your way out of it by flunking some of the rules? Yes, apparently you could, and that may be done. So, you know, you have the 1 year rule, the 3 year rule that we saw. On page 108, there's been various cases about like the tax court, that Fed second case, top of page 108, that they're summarizing that there's no formal plan necessary if you do it within a year, but if you don't meet the 1 year requirement, you need a formal plan. That's what they're talking about. And the control concept within the statute, in 332, when the plan was adopted. So they go into a bunch of different ideas here. The very end of that second paragraph, it's about 5 or 6 lines from the bottom. George Briggs Inc. versus Commissioner in a tax court case in 1975, which the IRS acquiesced to in 76. Notification of shareholders intent to sell all assets, redemption of all preferred, tender offer for minority shares and liquidation of such did not constitute a plan of liquidation, since a mere general intent to liquidate is not a plan. Revenue ruling 75-521, honoring that. You know, so again, this is another area of great uncertainty. And the next paragraph says you have to maintain control until you complete the liquidation. So you got to be careful selling the stock that makes you lose control. Again, another issue. When we get into mergers under state law, that gets a little bit confusing because the state law is all different. We'll see it in 368. You know, even though the statute requires a plan, most states require it. Said no, most states don't. What if the liquidating subsidiary retains assets, but to keep the corporate name, apparently, and we've seen this discussed before, apparently that is all right to keep the corporate name. So nominal amounts retained. And then they start to talk about section 368, which is the tax-free reorgs. And again, tax-free is a misnomer. But let's take a look at 368 in the code. That's chapter, I think, 15, the other chapter that we have. On 332, if you have a newer code, page 332. 368, definitions related to corporate reorganizations. And 368A1 lists the various types of corporate reorganizations, of which if you comply with these, you get a carryover basis in assets. The acquirer gets carryover basis in assets, generally speaking. Okay, so A is a statutory merger consolidation, and there's a raft of information on all of these as to what they really are. But again, just to get us started into the statute, a statutory merger consolidation, that's an A reorg. A B reorg, the acquisition by one corporation in exchange solely for all or part of its voting stock, or a corporation they're in control of, of stock of another corporation immediately after they have control against probably the 80% rule. These sections, when we really look at them, and probably this will be after the first test, as far as, when, it says solely in exchange for stuff, but you may find out it's not really solely. And kind of the idea there is, if you use cash or whatever, that's gonna be boot, and people are gonna have to report potential gain to the extent of boot received, kind of similar rules to like-kind exchanges, those sorts of things. So that's a B. C, acquisition of one corporation, solely for all or part of its voting stock, for the voting stock of a acquiring corporation, substantial of the property. So that's stock for property. D, a transfer of assets to another corporation, and you're dealing with control issues there. E and F, basically you don't see much recapitalization, and F is a mere change in identity. You might just change the corporate name, that'd be an F reorg. And G, I think, is dealing with bankruptcy. Reorganizations under bankruptcy law. So those are the definitions, and ultimately you'll want to learn what are we talking about here. Is it stock for assets? Is it stock for stock? How much consideration can you have? And the chapter 15, I think, goes into that. So we'll take a look at that. Okay, on page 109 of the textbook, again, the box there, what is section 337 little c all about? And again, 337C, 80% distributee. 80% distributee means only the corporation that meets the 80% stock ownership requirement specified in section 332 little b. For purpose of this section, the determination of whether a corporation is an 80% distributee shall be made without regard to the consolidated return regulation, which I think is stricter. So in talking about 337C, it says in a lot of situations it may possible aggregate the stock owned by affiliated corporations to apply the rules to define ownership of stock and whether there is control. Such an approach is rarely taken unless the statute clearly allows it. The statute usually provides operating rules to determine how indirect control can be established. Within affiliated groups filing consolidated return, the presumption is the other way around, that you can aggregate all the others. Now, 337C contains a clear rule to the contrary that prevents aggregation for 337 purposes, even for consolidated groups. And this is because of the 87 law, where the repealed general utilities, which had no tax on a corporate liquidation. And next paragraph, in the simplest form, the acquirer would create new subsidiaries, fund them with cash to buy a portion of the stock. Then you liquidate the target. And again, these are tools that you might use under different circumstances, which I'm not real good at. Okay, which Paul is. Again, what tool would you use? What are you trying to do? Are you trying to avoid taking on a liability? Is there a contingent liability there? Or do you have to acquire the name of the subsidiary? You don't want to lose that. Those types of issues. He'll be discussing the practical stuff. Okay, on 110, what if you have a parent that has debt on the subsidiary, and 337B provides that the controlling parent also holds debt of a liquidating subsidiary. The liquidating transfer to the parent will be treated as a non-recognition distribution under 332. So at that point, it looks like a non-recognition of merit. I think what we ought to do is take a look at these practice problems, kind of see what they help us understand this. Okay, question 1. The parent owns all the stock of the subsidiary, has a basis of 20. The sub only has one asset. It's worth 100 and has a basis of 50. What if the sub is liquidated? What are the results to the parent? Okay, under 332, there is no gain or loss on this transaction. And the parent's going to get a carryover basis in the asset. So, choice C, carryover basis, and the parent, no gain or loss. Number 332. So the subsidiary's basis was 50, now the parent's basis on that asset is 50. Question number 2, same situation. Parent owns all the stock, basis of 20, one asset worth 100. It has a base of 50 to the sub, and the sub liquidates. What are the results to the sub? Well, 337 says the sub has no gain, and answer B. Okay, number 3, parent owns all the stock, has a basis of 20, so this is the same fact so far. The sub has one asset, fair market value of 100, basis of 130. If the sub is liquidated, what are the results to the sub? Can the sub recognize the loss there? So answer A, no loss is recognized. Under 337, the parent's basis, so the answer is A. And the parent gets the carryover basis. Was that 130? I don't recall. Yeah, 130.
Do they get the basis even though it's greater than the fair market value?
Yes. Yeah, there's no rule that adjusts that.
Not so they can record the loss later.
Yeah, because they're just standing into the shoes of the parent, of the subsidiary. So if they turn around and sell the property to an outside third party, they'll have a realized and recognized loss for the difference. But there doesn't seem to be anything in the statute that affects that. Okay. Number 4, we've got the parent just owns 80%. and has a $20 basis in the subsidiary stock. The other 20% is owned by an individual, and there's only one asset worth 100 basis of 50 to the sub. If the sub is liquidated in kind, what is the result to the sub? Well, what happens here, this is the way I did it. They didn't give me any good numbers on this, but they didn't present this in the answer key at all. You know, if you look at 100%, you've got 100 and a 50 basis, so you'd have a realized gain of 50, but a recognized gain of 0. That's if it was 100%. Okay, now, if we have the minority, the parent has 80%, so if you take 80% times that would be 80, and the basis 80% of 50 would be 40, so you'd have a realized gain of 40 and a recognized gain of 0. The sub though, not the sub, the distribution to the minority um, 20% of 100 is 20, 20% of 50 is 10. You have a realized gain, the sub would have 10, and they would have to recognize that 10. So it's answer B. So whether they distributed the property to them, which I think they did here, or sold it to an outside third party, they're going to have to recognize that. So it says, the answer B, the sub recognizes gain on distribution to minority shareholders. Section 337 limits the benefit of non-recognition under 332 to distributions back to the controlling corporation. Distribution to minority shareholders are governed by 336, which is a taxable situation. So answer B to number 4. Number 5, parent owns 80%, basis of 20 in the stock, the other 20% is owned by the individual. There's just one asset in the corporation, fair market value of 100, basis of 130. If subco is liquidated in kind, what are the results to the sub? Well, when you do this relationship here, again, you're going to have 100,000. And the basis is 130. So you've got a realized loss of 30. The 80% parent is going to have 80,000 versus 80% of 130, 104. So that would be a 24 realized gain, but the recognized gain is 0. The minority, 20%, 20,000, and the basis is 20% is 26. We have a realized loss of 6, but a recognized loss of how much? Could you do something different? I think we already talked about it. Sell the property to an outside third party and you have a realized and recognized loss, then distribute the cash. that was 5. Answer was a no loss. No loss allowed. Okay, question number 6. A parent owns 100% of the stock of the sub has a basis of 20 in the stock of the subsidiary. Parent also holds a promissory note of sub reflecting debt owed by the sub to the parent of $60. The sub owns one asset, fair market value of 100, basis of 50. If sub is liquidated, what are the results? And the answer is no gain. And the explanation is that we're asking about the subsidiary, right? 337B provides transfer of property from a sub to a parent that might otherwise be treated as a non-liquidating transfer and payment of the debt that would trigger gain or loss will be treated as a liquidating distribution, and 337 would apply to non-recognition period. Okay, this rule only applies to the subsidiary. The parent will be treated as receiving a part of the distribution on the debt, and if it isn't enough, you're not going to get a bad debt deduction. It's not eligible for a bad debt deduction.
That was confusing, but I thought I saw some lines like there are some chances where they can get the, not bad, but yeah, like whenever your stock goes insolvent, they can get some kind of thing for that.
Yeah, I don't know.
Yeah, it says the parent corporation may be eligible for a worthless security deduction under section 165G.
Yeah. May.
Yeah, it sounds like a name.
Yeah, and then in the answer, they said no. Okay. The discussion problem, 1A, B, and C, I think was all you had on that. Is that right? X corporation, all the stock of Y, so X is the parent, Y is the sub, holds bonds of Y corporation, face amount of 500,000. Y Corp has 2 assets, one with a basis of 1.5 and a fair market value of 2, and one with a basis of 1.7 and a fair market value of 0.4. What are the tax consequences of the liquidation of Y Corp? And it tells me that we're looking at 332, 334, and 337. Liquidation of the controlled sub, including where the parent holds some debt as the sub. And the big issue is the sub solvent. That's the issue. I think in the textbook, maybe they talked about this. Does anyone know what the definition of insolvent is? Like say in Florida, liabilities are greater than the assets, than the fair market value of the assets. That's one. Is anyone familiar with the bankruptcy, involuntary bankruptcy rules? They define insolvency as you're generally not paying your debts as they become due. You are not paying. Not that you can't, but you are not paying your debts as they become due. And the bankruptcy law uses both definitions, but that one is used in involuntary bankruptcy, where someone's trying to shove you into bankruptcy. Everywhere else where they say insolvent in bankruptcy, because they're talking about the liabilities exceeding the fair market value of the assets. And the authors somewhere indicate that it's a little unclear which one they mean. That's pretty helpful. But, you know, again, this is another issue. We better look up first off, is the subsidiary solvent, and solvent how? Are they paying their debts as they become due? Okay, well that's one definition. What about the fair market value of the assets versus the liability? So you're gonna have to figure out what applies, and it's gonna depend, you know, on a lot of things. But the textbook indicates that, at least maybe to me, that is a little ambiguous. Okay, so here's what they talk about. So long as Y Corp, the sub, is solvent, the entire liquidation is non-taxable to Y Corp under 337 and to X Corp under 332. So those are the two general sections. X Corp would take the assets with Y's basis under section 334B, would inherit any other tax attributes that may exist. So, you know, that's the rule. The part of the transaction that might otherwise be taxed as a taxable transfer by Y to X with respect to the debt will be treated as a liquidated distribution under 337 for gain or loss purposes. 337 little b. 337 little b does not affect the debt holding parent's treatment. And then here's where it asks me to say something to you. The instructor might want to point out the several ways in which 337B operates only on liquidating subsidiary side. The amount paid with respect to the debt would be limited to the amount actually owed, and those sorts of issues. And since I don't really understand that, what they're trying to get me to tell you, I can't tell you too much. So I don't find this very helpful. Okay, now, same scenario, but we have minority shareholders. This was probably the most fun for me, where I spent a bunch of time trying to figure out what they were doing, and I'm not sure if I was successful or not, but some other stuff I got. Okay, so we have 20%. So we have 80%, 20%. So we got 100 in total, 80% parent, and 20% minority. Minority shareholder. And what are the tax consequences if they're a minority shareholder? Well, what's the rule about gain or loss? Generally, whatever goes to the parent, you're not going to recognize gain or loss, right? What goes to the minority, you're going to recognize gain but not loss. Okay, did we get that out of this, all this stuff? Okay, so those are kind of basic. And then they talk about a couple of different ways to attack this or to approach this. We could have a pro rata distribution. So if we have a pro rata and I think that I kind of played with. So we have gain assets and loss assets. Gain asset was 2 million versus 1.5, so we had a 0.5 gain. And the loss asset, 0.4 million versus a 1.7 basis, So you had a 1.3 loss. And again, if this all went to the parent, we don't have a problem, right? You just get the carryover basis for everything. Okay, so when you, the 80% versus the okay, so here we have that 500,000 gain. And the 20% of that would be 100,000. So that's going to be taxable to the sub. What about the loss asset? Uh, 1.3. 20% of 1.3 ends up being $260,000 loss. Can you take that? Nope. Can't recognize that one. Okay, so let's see if we can come up with a plan to save our client here. Who's our client? The parent, but they own the sub, so it's like both of them. Yes, ma'am.
So when there's multiple assets, we're gonna distribute them separately and treat them instead of a total.
Okay, now you're just asking about this situation here right now. What we're saying is that if you did it pro rata, then everybody gets their percentage. The 80% parent gets theirs, and then
Right,
So-
so you would merge the assets
Yeah,
together.
Yeah.
I'm saying when he has 100,000 gain and 260 loss, would we do the aggregate or we just treat them
well,
separately?
can you deduct the loss on the sale to the minority?
You can't look at the loss.
No, I'm trying to pretend like you're a hostile witness and just answer yes or no. Can you deduct the loss? Okay, so that takes, so the loss is disallowed. Will they tax the gain? Yes, they will.
How much
So you can't group them. That was your question.
do we do each individual asset?
I'm sorry?
But what if you have 5,000 little assets?
Okay, well again, first off, this is a pro rata. So whatever you have, it's pro rata of everything. This is pro rata. 80% of everything versus 20% of everything. So the 80% of everything doesn't have a gain or loss to report. It may have a realized gain or loss, but not recognized. The other 20%, you report the gain, not the loss.
Right, but if you have tons of assets, some with gain, some with loss, you have to do them all individually. Is what you're
Yes.
saying.
Yes.
Even if it's,
Well, then, you have a crew of gains and losses.
Yeah, you're gonna end up with a bunch of gains and a bunch of losses, and you're gonna report the gains, but you can't take the losses. So if it's 100 assets or 1,000, I don't think it makes a difference, other than you have a lot of work to do, which is what you're talking about.
right, okay, I understand.
I don't think it makes a difference. How can we avoid this problem? What's the simple way we might be able to avoid this problem?
Or just sell the asset. The loss.
Sell the lost assets to a third party, report the loss, because you can then. Okay, so that was simple. But what if it's too late? You've already done the plan, people weren't thinking too far ahead or whatever, and you've already got the plan, now what can you do? Could you make a non-pro rata distribution? Could you distribute the lost assets to the parent and the gain assets? You actually can. I believe you can. And this is where I tried to figure out the numbers. And I could only get.
Well, it says it in the next one.
Say again?
In the next one, it says assume the loss assets are attributed to export and gain assets.
Yeah, so the question is assuming. Okay, so,
Yeah, on the next one.
yeah, thank you. So if we distribute the loss assets to the parent, okay, so again, the textbook answer to me says probably best is to sell the lost asset, distribute the proceeds. You can do that, but it might be possible and to distribute the loss as and you're right. C, that's where it came in. Okay, question C. Thank you. So trying to figure that out, they give me some numbers. Assuming the lost property is entirely distributed to the 80% distributee parent, the minority shareholders receive a portion of the gain property valued at 0.48. So I tried to figure out how they got that. I think I got it. That one I think I can figure out. So we have the loss asset. Fair market value is 0.4. And the gain asset, fair market value is 2.0. These are in millions of dollars. So the total is 2.4. And if you take 80% of that, I think you end up with 192. Yeah. So 1.92 goes to the parent, and 20%. 2.4 is 0.48 goes to the minority. Okay, that I finally figured out. They give me that number and it made sense. Then they said that the basis related to that, this is the number I wasn't able to generate. And this is what drives me nuts preparing for this class, because I spent all this time and then I can't generate a number. It takes me 45 minutes and I can't come up with it. But figuring out the basis, they said the basis. So it said, assume that the lost property is distributed to the 80% distributed. The minority shareholders receive a portion of the gain property value at 0.48 with a corresponding basis of 0.36. So we got 0.48 and the basis is 0.36 according to my book, which would have the gain being, 120,000 or 0.12. I don't know where they came up with 36.
In that case, aren't you grouping them?
Say again?
In that case, aren't you grouping them? So you-
Yeah, I kind of, I took the, let's see, where's the basis on the gain asset, and I ended up with 30%, not 36. I just couldn't get their number. Yes.
Isn't the question like you separate them, you give one to the minority and one to the
Yes.
person?
That's what we're doing.
But isn't 2 plus 0.4, are you grouping them right there, or?
Again, they said what we're doing, we're not grouping it, we're distributing the lost assets to the parent because they get the basis, the larger basis. Because if we don't do that, if we do it pro rata like we did before, then you lose part of the, you have a loss you can't recognize. So they suggested distribute all the lost property to the 80% parent, and they said the minority will receive gain property value at 0.48, which I figured that the total value is 2.4. The fair market value, the total fair market value is 2.4. I think they're entitled to 20% of that, and I think that's where my answer book came up with 0.48. They're entitled to 20% of the fair market value. Doesn't that make sense?
So what if the numbers didn't work out, you couldn't do it? Like if you wanted to do gain and loss assets a certain way and that calculation didn't work out, you couldn't do it? Is that the purpose of that calculation, to make sure?
No, the purpose of that calculation is to find out how did my teacher's manual come up with 0.48. That was the purpose of the
But
calculation.
what's 0.484?
Well, what I'm saying is, if you take the net fair market value of the assets,
Right.
and you take 20% of that comes to 4.48.
And then what is the
20% of 2.4 is 0.48.
Well, I get that, but what does that
So,
mean?
but do you agree, well, don't you agree that if you were a 20% shareholder, you're entitled to 20% of the fair market value of the property? I mean, you can, if you don't want to do a pro rata distribution, that's great, fine, do what you want, but I'm entitled to, $480,000. Remember, this is $480,000.
So under that equation, we're not assuming that the lost assets are going to the X Corp and the gain
No,
assets.
we are.
Okay.
It's just that the minority is entitled to their 20% of the total fair market value of all the assets. This is the fair market value of all the assets. So they're entitled to 20% of 2.4, which is 0.48.
But it's, they're entitled to this, but this is not what they're getting distributed.
Well, again, this is a suggestion of how to do a non-pro rata distribution allegedly fairly. I mean, would you agree, if you are a minority, that you expect to get 20% of the net fair market value of the assets in the sub?
Right.
Does everyone agree with that? Doesn't that sound fair? Okay, so if the net fair market value of the assets is 2.4 million, 20% of that is $480,000. So I think that you're going to have to distribute that 20% to them, which is because it's worth $480,000.
So you would distribute the entire loss asset, which is 400, and then you distribute 80,000 the gain asset.
Yes.
Is that what you're trying to say?
The other way, because the loss is going to be 80%.
Yeah, the loss is going to the parent.
Yeah, so you don't take a portion of the.
So the parents are going to get $1,920,000. The minority are going to get 0.48. This comes up to 2.40.
So the parent would take the.
Say again?
Parent would take the 0.4 fair market value of the loss and then any additional.
Remember, the parent doesn't recognize a gain or a loss from the deal.
Yeah, but they would be taking the loss.
Yeah, and why are we giving them the loss? Because they can use it, can't they? They can either use the higher basis and write it off, or they can sell it. So that's why you're doing it. Now, I would think that the textbook would have pointed out to me in my manual that, oh, by the way, there's a revenue ruling that says you can't do this. No, I'm serious. And they didn't discuss that. So I'm assuming for the moment, not that I wouldn't check it if I was really doing it, but I'm assuming for the moment that you can do that. But again, you have to agree that if the total net fair market value is 2.4 million, 20% of that is 480,000.
Right.
If you agree with that, we're okay. Yes.
Okay, so basically what you're saying, so in order to calculate the loss, instead of what we did before, the 0.4 minus the 1.7, instead, it'd be 0.48 minus the 1.7 since you're determining.
You know, it's point, here's the problem. They told me in the answer key that the basis is 36. That's what they told me. And that's the one I could not figure out how they got it. I just, you know, I mean, maybe if I had another hour, I could.
Yeah, those
Yes.
ones, how are you supposed to know, because isn't the whole point, like, for their basis to offset their gains, and that's how you determine them? Like, if you're a minority shareholder, you have, I guess if you.
No, remember, this is the subsidiaries gain or loss if they have to report. So we're dealing with subsidiary basis in those assets. So again, I don't know how they came up with this. Let's pretend it's correct. You know, again, this is what I don't like. You know, this whole area is, you know, like just it's probably just as foreign to me as it is to you.
I know how
You know,
they got it. I just figured out how they got it.
Okay, and we have a brilliant student.
No, sorry.
That's
They took, so you're assigning the 0.48, you're taking it out of asset one is what they're doing. So you take 480,000 divided by 2 million, and that basically gives it to you, and then you apply it to the 1.5 million.
Show me how to do it again. So this is interesting.
Take,
Let me get a marker that might show on the board.
I think that's why none of us were following you. Figure out what you were doing. So what they're doing is they're taking, I think this is right. They're
Okay, well, let's try out the numbers. Go
I know
ahead.
if I'm wrong, I'm so stupid, but.
That's all right.
They took, they're taking the 0.48 that they're entitled to, they're taking it out of asset one.
Okay, so that's the one that has the gain in it.
Yeah,
So 2.00, and we're taking out of that 0.48.
so what percentage is 0.48 of, so I just took 0.48 divided by 2,
Okay,
and I got 0.24. Now multiply that times 1.5, and you get 0.36.
and where's the 1.5?
1.5 is the basis assigned to asset number one. So they're basically saying like that the minority is receiving basis and or receiving value only in that asset number one, so they have to take the applicable basis for that asset.
Just a second, I have to write this down because next time I teach it, maybe I'll
Oh,
have a
listen,
better
I
shot.
figured out, so what you were saying was.
Yeah, so they're taking more than 20% out of that asset, so their basis has to be more than 20%. That's just gave an apple how they got it.
Okay, so we take the gain asset of 2.0. We take out 4.48, which we know we calculate that. Okay, so we end up with 0.48 divided by, and again, why is it divided by 2?
2.0.
Oh, 2.0, okay.
Is the,
And that equals 0.24.
Yeah, so they're taking 24% of the asset, basically. So they have to take 24% of their basis.
Okay, so 24% times the basis equals 36. Okay. I hope you're right, because it sounds so good. It really does.
It's not a lot, it's there.
Okay.
Could be a coincidence.
No,
Because if they were, okay, so if they were taking all of it, they would take 0.48, but since they're only taking asset one, they're only taking 0.24, that kind of the logic. They're not even touching the lost asset.
Total assets 2.4. I don't know.
Yeah.
I had it figured out before, but I couldn't get to the basis, but at least I understood that. So, I mean, this actually made sense to me, the 0.48, very clearly.
It does, but I just don't understand why you're grouping the assets if you're just giving the gain asset to the 20% minority?
Well, you're not giving all the gain.
Okay.
You're just
That's
giving
what
a,
it makes it seem like, you're giving all of the gain.
yeah, no, you're just giving a portion of the gain.
Okay.
So whatever that takes, you're giving a portion of the gain, and therefore the sub's gonna have to recognize the gain on that. But if they had a loss, if you did it pro rata, which we did before, the loss part was disallowed to the, on the sale or distribution, deemed sale, to the minority, yes.
Okay, because we were all getting confused because we said don't do each asset separately. So that's what was confusing us when you brought in 2.4, because that's really
Yeah.
But I think what they did was saying that if you gave them only the gain asset, they will have a gain of 500,000. But they're not entitled to that amount because they're only 10%. They cannot exceed 2.4. I mean, they cannot exceed 0.48, but they can't go over that amount. That's what they're trying to say. They're limited now. So because they can only see 0.48 of amount of gain, now we need to go back and calculate
That's
what their
0.48
basis is.
It's not even a gain, it's like could be 0.4.
Right,
Yeah.
of the,
Yeah.
what they're
They
receiving.
only entitled to that amount, so now we're.
Okay, how many people understand it then?
Now that we've all contributed. Finally.
This course is such a challenge, folks. You know the number of hours I've worked on this. I mean, and the other thing is, I'm not as excited about this as I used to be. Last week I was excited. I've got to work on my positive approach. But again, I haven't made up your exam yet at all. And no, but it's going to be issue perception, and then I'm going to give you some stuff that's mechanically applying 351, and all that stuff, and 357. Those are mechanical, pretty straightforward stuff.
What should you do?
Yeah. So yeah.
So the 0.36 is just a portion of the basis for the gain asset.
Yeah.
Yes.
Okay.
Yeah. And that might be the way you get to it.
Yeah, there's
It's certainly better than what I can come up with. I tried a bunch of different things. But again, okay, so again, we've been diving into the minutia. Let's back away because, again, what's the deal? If you have minority shareholders and you give them property, then you have to recognize any gain. It's reported. Okay. However, if you have a loss, you can't take the loss. So that was the motivation for giving all the loss assets to the parent. And quite frankly, I don't get how the IRS would let that happen. Really. But there's a lot of stuff in this area that there's tons of rulings and things out there, private letter rulings, and they're all a certain way, and they let certain things pass that I think would not. So I mean, if you become a specialist in mergers and acquisitions, and there's one lawyer downtown, he's done that all his career, but he knows the tools, but he's way beyond that. Because every time something comes up in a deal, he says, well, then we can't use this, we use that. And I'm sitting there, I'm astounded because, I don't know those rules at all, but I've never used them to make money. And when you use it to make money, you become familiar with the tools, number one, and then what can you use to meet a particular issue? And then I'm pretty sure a lot of times I think you're going to be getting a private letter ruling anyway. So you're trying to structure it where you think the IRS will accept it and go from there. Right?
So I must have misread this question because do you even consider the earnings and profits? Because I thought you would have taken the whole, you can take off.
Okay, first off, if the parent gets 100%, then the earnings and profits, it's just like the parent earned them. So let me give you the rest of C. Okay. Y Corp has accumulated earnings and profits of $800,000 before it was liquidated. What's the effect of the liquidation on the earnings and profits? Assume the loss assets distributed to the parent. and the gain assets to the minority shareholders. And this is what I'm instructed about this. This problem deals with the E&P of the parent corporation after the liquidation. You know, what's the effect on the parent? And it says, look at another advanced topic for a full discussion of minority shareholders in the E&P situation. Assuming the lost property is distributed to the 80% distributee of the parent, the minority shareholder would receive a portion of the gain, which is 0.48 minus 0.36. 0.12, again, 0.12 is $120,000. This distribution to the minority shareholders will increase Y Corp's E&P by the the 120,000 or 0.112 million, right? In other words, your taxable income will go up. It's a realized and recognized gain. It's either in the taxable income number to start, but we're doing this as we go along. So what's the effect on E&P? You're going to add it. Okay, so E&P just went up by 120,000. Okay, everybody comfortable with that? Okay, E&P went up 120 because the gain is recognized under 336A. And then it reminds you, when you're dealing with earnings and profits, and again, earnings and profits, the way I teach it in the other course, is basically, is the money in the bank? Okay, so yeah, the money's in the bank on this one. Okay, but the amount will likely be reduced by the increment to federal income tax owed as a result of the distribution. So you have 120,000 gain, that increases earnings and profits. But if you've really studied earnings and profits very much, you're going to have to write a check to pay the tax on 120. So there isn't 120 in the bank. There's 120 in the bank less whatever the tax is. You know, let's just let's pretend the taxes were 20. There's only a net 100 in the bank, so E&P will only increase a net 100. Remember, earnings and profits basically is the corporation's ability to pay dividends. And it's an economic concept. And the only thing different between economics and this area is that most of the time, you know, for taxes, we need a realized and recognized gain as a plus, you know, to have the bank account go up. Whereas economics value stuff at the beginning and the end of the year, and GAAP does somewhere down too.
Don't we reduce it by the basis too? Or not?
Yeah, and the thing is that there's some other stuff.
Because that's going to be an overall decrease. But that's
Yeah, so under the assumption herein, E&P is reduced by a distribution to minority share. You know, the E&P would be reduced by 0.48, the fair market value of the gain distributed to the 20,000 shareholders. So again, first off, you know, you start out by when you distribute property and it causes you to have a gain, realized and recognized, that increases your E&P. But then the actual distribution of property reduces it, and if it's appreciated property, it reduces it by the fair market value.
Oh, not by
But that remember, it's carrying out dividend treatment with it. You see? Okay, so now your E&P went down because we just pulled out, you know, a dividend. Okay, so the E&P will be reduced by 0.48, the fair market value of the gain distributed to 20% shareholder. Accordingly, the E&P account transferable to X will be 440. So remember, the parent's going to succeed to the E&P of the sub. But we've already carried out some of that, so the E&P's been reduced by that distribution that you were taxed on.
Did you say it goes to the entire E&P goes to the parent?
I'm sorry?
Did you say the entire E&P goes to the parent?
Yeah, after you adjusted it for the distributions to the minority shareholder. Okay, so this says, according to the E&P account, transfer to X corporation will be 440, which is the 800,000 we started with, plus 120 gain, minus 480 fair market value of the gain property. And again, you would have reduced it by the taxes. They don't say that, but you would have reduced it by the taxes. And let's see. go an alternate assumption, which I'm not going to get into on E and P. Now, there was a few other questions there that I didn't assign. I just wanted to tell you the issues that were involved there, even though I'm not going to run the numbers. Little d. What if Y Corporation had minority shareholders who owned only 20% of the common stock and had issued preferred stock worth $100,000 to a friendly bank before the liquidation? And it says here, this problem deals with losing control before the liquidation. So it's a control issue. And it says the discussion in the text and the authorities cited in the advanced topic on this issue, which we didn't address, indicate the steps taken to avoid qualifying under 332 would ordinarily be honored. See, 332 is not a mandatory provision. You can get out of it if you want to, and they're trying to flunk. They're trying to flunk the control requirement, you see? They're trying to flunk the control requirement. So the question here is whether the term of preferred stock is a sham or not. So you got to look and see if it's real preferred stock, or do you remember that term non-qualified preferred stock? Okay, that is it non-qualified preferred stock. And then it says if Section 332 liquidation is busted, kind of a jazzy term, gain and loss will be recognized on the liquidation of 336. Again, you might have some loss disallowances. Thus, busting Section 332 liquidation that was making it not qualified will be a good strategy only if the burden of the gain on the stock and debt holdings and the Y Corporation's gain is offset by the recognition of Y's losses. So again, if it's not, if you bust it so it doesn't qualify as a 332 liquidation, that means that the gains and losses can be recognized. So that was 4. Question 5. No, it's not. It's 2. It must be 2. Yeah, that was little d. Okay. Yeah, problem. Okay. I'm sorry. Problem 2. Okay, problem 2. As in problem 1, X owns all the stock of Y, holds bonds of Y, face 500,000. Y Corporation has one asset, basis of 100 and fair market value of 350. Now you notice that they owe more than, right? Their liabilities are 500 and fair market value of their assets is 350. You see that issue there? Okay, so what are the consequences, etc., and then they kind of change the number. And it says this problem discusses the effect of a parent insolvency because the debt issued by the sub and held by the parent. Here, Y Corporation is insolvent. That's the sub, and you can't have a 330 liquidation in that situation. And you get into some other issues, which I'm not going to get into here. But the idea there is that all the assets are transferred in satisfaction of debt. So you might have a cancellation of indebtedness. You owe 500 and you're accepting 350. So Section 108, cancellation of indebtedness, which might apply to if you got other assets from the sub or maybe your own existing assets. I'm not sure where you would adjust basis. Do you call that Section 108? You can adjust basis. So that's another issue that they're talking about. Parent insolvency. And maybe you can take a worthless securities deduction. I think Randy knows that. Ordinary loss would be 165 G3. And B was where instead of bonds, they had bonds of 200 and preferred stock with a liquidation preference of 300. And there they said this variant deals with the lack of a return in every class of stock, even though the sub is insolvent in the ordinary sense. And then it says under the case law, there'd be no liquidations. This is no return on the common stock, etc. And again, you're going to deal with it. They don't talk about, but insolvency, the definition of what insolvency is, and which one do you use. Okay, let me go on to 15 because I'm trying to remember how much. 15 we're also going to cover the problems next time. So we've already done what I wanted to do in 15 in the sense of looking at 368A1, which is your definition of the reorgs, 368A1. And they get into a lot of different terminology, you know. And a lot of that terminology is going to be discussed later when Paul goes over this stuff also. Okay, so let's just take a look at chapter 15. I'm on page 265. Again, 368A1 is the key code section. We already looked at that. And you may be looking at a stock or an asset acquisition, and it could be non-taxable if it complies with 368A. Reorganization is a term of art. You got to satisfy something under 368A. So when I took the reorgs course in law school, that's basically all we studied was 368A1 and all the different ramifications dealing with that. Now, you know, a lot of times you're dealing with the acquiring corporation and the target corporation. That terminology you're going to hear again. You know, we have the corporation, the acquiring corporation, and we have the target corporation. And basically, what they're saying is this is just a change in form. But since this is a change in form, it's tax-free. Now, is it tax-free? It's not really tax-free, is it? Isn't it tax-deferred? So if you got a stock-for-stock situation, and you own stock in a subsidiary, and the acquiring corporation acquired your stock, and you get parent stock instead, stock for stock, and if there's no boot, there's no other money, then that's probably going to be under one of the reorg sections. So if your basis in your stock is 100 and the fair market value is 1,000, you've got a 900,000, you know, let's say potential gain, which you would not report because 368A1 says it's a tax-free reorg. It's not really tax-free. If you turn around and sell the stock that you received in this acquisition, then your basis is still just 100, and you know, and you sell it for 1,000, you might have a huge gain of 900,000 for talking adding a few zeros. So it's tax deferred. I'm going to call it tax free. Non-taxable is probably a better term. Non-taxable. It's not taxable at the time that you do it. So the second paragraph there, all the transactions in 368 definition of reorg require a significant portion of the consideration used by the acquirer consists of stock of the acquirer, or it could be the parent of the acquirer. Beyond that basic similarity, each transaction type has special requirements, and generalizations are difficult to make. The service has summarized 368. To accept from the general rule of U.S. tax law that the exchange of property gain or loss must be accounted for. So it's deferring that. Next paragraph, the reorg provisions generally are easy to justify because otherwise we wouldn't have a lot of changes in corporate structures, you know, that sort of thing. If you look on 266, second paragraph talking about the detailed requirements of the statute are harder to justify. They're kind of old. They're the oldest in U.S. tax law based on the author's opinion, the two authors, the two ladies. The reason lies in the fact that the provision began as a legislative reaction to early opinions saying that all corporate restructuring were taxable. So they finally got something in the code that said, no, they're not. So it was trying to get around that. And then if you drop down about half, maybe 10, 11 lines down, it says the rules for reorganization evolved through a series of interactions with Congress, the courts, and more recently the Treasury, so the IRS, the Treasury, in the regulatory process. With the courts tending to interpret the language of the statute strictly at the urging of the IRS. And a couple more lines down, as a consequence, there are a number of seemingly arbitrary differences among the patterns of transactions that qualify as reorg. And the statute will continue to be changed. If you look at the bottom of page 267, the next few pages kind of talk about the basic patterns. I think that's really all I'm going to do tonight. Okay, 3 basic patterns, bottom of 267. Acquisition of the stock of target. It's generally thought to be a B reorg, stock for stock. That's little I, double I, acquisitions of the assets of target. So C reorg is acquiring the assets. A B reorg is acquiring the stock. And triple I, transactions whereby corporate structures are combined by operation of law, and that's probably an A reorg. Statutory merger consolidation is called an A reorg. And if you look on 268, first complete paragraph there says, you know, figuring out what it is just the first step, because the step transaction doctrine could come in and kind of mess you up and recast the whole thing. And this is why I think you got to get a ruling if you can get it most of the time. There's enough money right in it. So if you look about 4 lines from the bottom, an acquisition of stock followed by liquidation could be treated as an acquisition of assets. A merger can be treated as an acquisition of stock and so forth. Next paragraph, the simplest versions of these 3 types of, so you're going to hear an acquisitive reorg, acquizitive reorg. Yeah. One corporation remains holding the assets that were transferred without gain, and only one corporation stock that could be received by target shareholders in exchange for their target stock. So again, the acquiring corporation and the target. Again, the language, the terminology that you're going to see. Again, acquisitive reorgs are usually conceptualized as an exchange, transfer of target's assets in exchange for stock and other property to acquire, or followed by the retransfer of stock and other property received by target, distributing it to the shareholder. Once target has transferred its assets to the acquirer in an acquisitive reorg, it's probably not going to stick around other than passing the assets to the shareholders that they're gonna be done. And then the next paragraph, these simple reorg transactions can be complicated by the possibility they can be accomplished in a triangular dealing, three parties way. Either because the stock of the target is issued by a corporation that controls the acquirer that obtains target, or the target stock or assets are transferred by the acquirer to another corporation. Again, a lot of times there's non-tax reasons for this. You don't want some liabilities, or you want the risky stuff to be in a subsidiary. And maybe you create a subsidiary to acquire the assets. So, and the concept of boot is here so that if you receive cash or non-like-kind property, even if it's a tax-deferred exchange, you're going to recognize gain in that situation. So I think I'm going to stop there because I didn't give you a break tonight. I think I'm going to stop there because we're going to pick up on this chapter next time. Now, I'm not going to collect the homework from home. It's unusual, but I'm not going to collect it. Okay, so.